Can you hear me?
Yes.
Yes, we do. Excellent. Let's see if it works with the phones now. All right, I'm going to do it this way. Just I'm not sure if the earphones are working. Okay, well, welcome everybody. I hope you're well and healthy. I'm going to change the format for this week slightly. We're going to start with the macro outlook, and then we'll open some Q&A on the macro side. So as every week, if you want to, please submit your questions through the chat. I'll respond to those, and then in the second half, I'll be talking more about the for those who this might be the first call, maybe the strategy in a bit more detail. But I think there's so much happening on the macro space that perhaps we focus on that first. So let me share the materials. Second. So hopefully you can see the screen well. I'm going to share the screen now, and it's been quite a month. I'm gonna mute you guys 1 second. Now that I know you can hear me, you can unmute yourselves if you have any questions. But I think it's better if you submit them through the chat. So okay. So let's focus on the macro side. A lot happening. I think this first slide pretty much speaks for itself in terms of the price action on the equity markets and how the S&P has made historical highs, a very sharp rebound from over the last few months. And how this has happened alongside a pretty weak dollar and some major changes in the outlook by the Fed. So I'd like to perhaps provide and focus on the big picture and start with what's happening at the top level. And I think it's important to put some perspective. And as you know, my view is that to a large extent the damage was already done prior to COVID. Over the last decade, as you know, we've had effectively a process which I describe in one sentence, which is the transformation of risk-free interest into interest-free risk, and how once upon a time the 10-year bond would pay you 5% per annum, and how that same bond not only paid you 5% without taking any risk, it was also effectively a great defender, because during a crisis yields might go to zero and you make 50%. That has been dramatically transformed from a world of risk-free interest to 30-year bonds at negative nominal yields. And this dynamic has, in my view, just created a massive distortion in asset valuations. Anything that is effectively priced using discounted cash flows or anything else is obviously dramatically distorted. And in that sense, we were facing what I would call a very fragile equilibrium, a situation, a pre-existing fragility. So in that sense, when we look at COVID, obviously it's a shock without precedent, and it's a dynamic that forced mommy and daddy central banks to intervene in full force with monetary and fiscal measures we haven't seen pretty much ever. So in that sense, this situation, where we have damage that was already done, persistent fragility, a shock without precedents, and monetary and fiscal response without limits, have put us forward into a situation. You've seen this slide in one way or another over the last few months. Things have been playing out according to what we expected in some way. And in that sense, we think that the thesis that the bubbles that we've created are too big to fail, and that we're engineering an exit into inflation, it's underway. Having said that, we look into more detail. We've seen obviously a massive disconnect between some parts of the global economy and the markets, where again we're making historical highs despite unemployment and much economic activity and lots of trouble in many areas of the economy. We see also how the idea and the question of whether we can solve effectively solvency with liquidity and debt, with more liquidity and more debt, this is a question mark. For us, you're not going to resolve solvency just by printing more money and debt. We're transforming these problems. If you think about what higher interest rates would mean to the world given the current circumstances, I think 5% interest rates, which would be normalized, or considered a normalization, is science fiction. Interest rates of 5% obviously would create havoc. So we're virtually working in a world where it's almost impossible that we will normalize things. Clearly, and we've been saying this for a while, the virus will go, maybe the vaccines will come, but MMT and a lot of these measures that have been introduced will stay. So we're looking at, once again, a situation where central banks and governments are calling for exceptional measures, temporary measures, which eventually become permanent. So in that sense, we continue to see how they will appeal to the fragility of the recovery, and we're looking into pushing the boundaries in ways that stay on. And this has happened all the way since 2008 and before. We see in that sense how the debate of deflation versus inflation, my calls for inflation, in the midst of the crisis, were somewhat coming as a surprise to some people. And as we will discuss in more detail shortly, clearly there are lots of deflationary forces, but these are being more than offset by central bank printing and other measures. So we are facing, in my view, situation that will lead to stagflation. And we'll talk about the Federal Reserve and what they've done recently and why it matters. In this context of artificial low interest rates and certain rigidities in the system, we're looking at what I think are artificially high valuations, which we know for a fact they do not last forever. But when you're dealing with bubbles, obviously the rule of thumb is they tend to go a lot farther and last a lot longer than anybody can anticipate, yet they also collapse much faster and much farther than most people anticipate. So I think we are, for those of us old enough to remember previous bubbles, I think there's lots of potential similarities to the dot-com, and we'll see how this plays out. But certainly very, very steep valuations, very aggressive. So when we look at complacency and how all these acronyms, FOMO, TINA, fear of missing out, there's no alternative, or things like the stock splits, which are phenomenal. I mean, you see how with some reason Apple or Tesla are effectively creating almost free money just by making their stock available to in smaller pieces. So a lot of things that are again a little bit they're questionable. Certainly, it's the price actions what the market is telling us, but there's a lot of exuberance. We look at within the context of this currency wars playing a big part of the game. We've seen August was the worst month for the dollar in over a decade, and surprise, surprise, the ECB came out yesterday saying that the exchange rate matters, and obviously Europe is not welcoming such a strong dollar. So this was to be expected, more to come, and we'll see how much room we have, but certainly currency wars is at the center of a lot of what's happening on a global scale, and more to come, where I think, as you know, gold and real assets in general are likely to play a strong role. We see the devaluation of the dollar as one of the key central themes, alongside with the renewed view on inflation and what it could mean eventually to other economies and debt monetization. Trade wars, clearly a defense mechanism against currency wars, and ultimately, just to summarize this first point on volatility, which has compressed. So that overview, I'd like to perhaps zoom into some of the topics I briefly discussed in this initial overview. And this is a slide that I've had pretty much every month since March. And we saw how March created this synchronous shocks and volatility, demand, supply, energy. I mean, many people have forgotten, but we did have negative oil prices not that long ago, and obviously healthcare crisis and a political crisis. I think looking into the situation now, I'd like perhaps first to focus on volatility. This is one of the areas that is staying. My view is that we would see sustained high volatility for a while. I think 30% in the VIX is a reasonable level based on a lot of the dynamics in the market. We've seen how the VIX has been compressing significantly and taking us to the low 20s. And for those paying attention, you can see that the VIX is, despite the continued strength in equity markets, is holding. In fact, is starting to tick higher. We'll see what that means, but certainly volatility, both implied and realized, are key things to watch. And as we've discussed at length, much higher volatility effectively leads to higher value at risk, forced liquidation, and others. So I think vol and high vol is something to watch in this very complacent market. Healthcare, there's very strong and very smart people, calling for a vaccine to be imminent. The market seems to believe that. I hope so. As in that sense, we'll see what happens. But yeah, if you look into the timelines, it's unlikely that we'll have anything for this winter. Everybody is following this, but there is plenty of room for volatility and surprise. And again, we're all hoping that we will find a solution. In fact, the market, I think, is very much pricing that. So we're back to a situation where there's room for surprise on both sides. And politically, needless to say, we're facing the US election. A lot of the measures that are being taken as we speak, monetarily and others, are it's explainable perhaps within an election year, but clearly Trump is putting everything on the table to try to effectively get the price action that we're seeing. And I think the central bank, the Federal Reserve, is helping. So quite a dramatic change. Here we see what I mentioned in terms of volatility, how we've gone from the inverse relationship, the bubble anti-bubble relationship between equity prices and vol, and how we've seen these much higher equity prices, and how the VIX remains still somewhat elevated in the mid-20s, but edging slightly higher. We'll see if it's a technical nature or perhaps is telling us something, and we might see some surprise on that side. In terms of monetary policy, just to have a closer look again and go deeper into the Fed, we are, yet again pushing the limits of monetary policy, trying to print our way out of a problem. We've seen lots of things happening, obviously zero rates, QE, even negative rates in some parts of the world, how we've been buying equities, credit. I mean, I think they talk and they discuss it and they present it as stimuli. It's a mega bailout. That's what it is. And what we have is, helicopter money, with checks in people's pockets. And all of these effectively underline currency wars. The US dollar and the Federal Reserve, by taking these actions of printing and lending ad infinitum, the degree of freedom is inflation and currency devaluation, both of which are desired outcomes for the Fed, or be careful what you wish for in some ways. But certainly a weaker dollar is welcomed, and that in terms of total return is having an impact. We see how a weaker dollar helps equities, and how the euro is coming off, and euro stocks is rallying big time. So this is a total return game, and I think it's important to understand that also on the currency front. So in that sense, I stress the role of currency wars, of this, buying without limits, and as potential cards that the central banks have as plan B, C, if we have another wave of trouble. And I insist, when you actually do this, you're not fixing the problems, you're delaying, transferring, transforming, and eventually enlarging. Those who are calling from Latin America or other parts of the world, are quite familiar with the dangers of monetary and fiscal without limits. So in that sense, this monetary abuse is leading to a second wave, where effectively we're printing money and giving it to governments first, and now to corporates and whoever's needed. So looking to effectively transfer and transform this problem, and how we are effectively, all this money that's been printed and lent, it's allowing governments to spend at will without effectively, whilst increasing debt, and with the miracle, which is no tax increases, in fact, tax cuts, like Trump, which is basically just throwing fuel in every single dimension. This is, again, leading, also adding to bailouts as something exceptional, and the whole MMT, or modern monetary theory, which is just already a reality and likely to stay. And again, this feeds back into trade wars, as a mirror image of currency wars, and as a way that I think what is happening here is we are seeing central banks and governments teaming up to effectively avoid the collapse. And this is a problem. We are just embedded in the same cycle. You know, as I mentioned, is not, in my view, resolving things is transferring and transforming the problem. Now, going back to inflation, deflation, this is a theme that it's very relevant, and it's this month in a way more than ever, with the Federal Reserve effectively changing their stance. It's relevant because you know, historically we've looked at the 2% inflation target as a cap, some sort of limit, and central banks and the Fed in particular looking at their mandate as financial stability. And basically we know that as Voltaire said, you know, paper money could potentially revert to its intrinsic value. And so what the Fed has said is they're no longer looking at the 2% as a cap. They're looking at an average, which means they're going to be able to overshoot the 2% target. And I think this is, again, something that they're doing preemptively, because they know that they're going to need this. They know that there's no way we can get out of this debt cycle by paying the debt or normalizing things. We are going to have to deflate it. They hope that they can accelerate this process and basically do it within control, in a controlled manner. The risk is, this is obviously we get central bank independence is clearly no longer. They are in the hook, but it's also about inflation expectations, and I think that the market is already telling us clearly, not only on the real assets or things like gold, which have had reached all-time highs in dollars. They have already reached all-time highs in any other currency before, but also through the equities and how, you know, the market is playing this game and these rules of the game that have changed. And so we're looking at, again, a scenario where the bubbles, I think, are the new enemy. Central banks, which historically fought inflation. So if inflation was coming, the rules of the rule book would tell us interest rates will go up and bonds will go down. We are, in my view, and I've been saying this for a long time, the rules have changed, and you're going to see a situation where we will have inflation and zero interest rates. So this is a new paradigm. It has big implications for markets, and again, it's something that has significant danger in the process. So complacency. I mean, this is a new slide. I was just looking at, again, many of the things that we're seeing, and how, you know, the central bank put this idea that mommy and daddy are there and will always be there, and they have the will and the means to save us. Effectively is turned into a little bit of a whatever it takes, in the sense that they are in a desperate situation to prevent things from collapsing, whether it's COVID induced or not. This leads us to a situation of the problem I've always talked about, of who polices the police. We have you know, on the back of this complacency from the central bank put, we have an ultra low yields. We're once again into this desperate search for yield and return. This is creating a number of risks, like hidden leverage. We've seen correlations increasing and the risk of false diversification. We've seen something clearly, you know, throughout this period, you know, a lot of share buybacks, which effectively work very well on the way up, but then, as we saw with the airlines, lead to hidden leverage and bailouts on the way down. We see the fear of missing out, you know, taken out to in some parts what I would consider a bit of mania. Time will tell. The idea that there's absolutely no alternative, and what do I do with my money, again, is leading to this common tide. And you know, these bubbles that are too big to fail, I think, are leading to opportunities in the anti-bubble space. And clearly, we have an issue in the table, which is inequality. This is you know, the asset price inflation, how the difference between what is, in my view, blatant inflation and salaries and others, and disparity. This is creating obviously things and social unrest, which it's brewing in the system. We've seen it before, even if we can't quite finger point at central banks effectively stirring this. They are the ones behind this. So it's a tricky situation. Those who have a copy of my book that I dedicated, you know, I tend to say, I hope you like it. I hope I'm wrong. Many of the things that are happening are unfortunately you know, things that we've been calling for, and they're not necessarily good. So we'll see how things continue to pan out. But again, I think that the next 10 years, it's a game of you know, you're either long or short inflation in a way, and I think your team needs to be balanced. This is not just about scoring goals; it's also about, more importantly, about capital preservation. No matter how complacent the market is, there'll be pretty, you know, I think very sharp corrections, as we've seen in Q4 18, as we've seen in Q1 20. I think we should expect more to come, even if we don't know exactly what will trigger those. This is a game where we're going to have to balance things out, but within a framework where I think inflation will drive. So the strikers, clearly, equities are favored to credit, in my view, in terms of asymmetry. If Telefonica bonds pay you 100 euros back in 20 years, how much will those 100 euros buy you in 20 years? Probably not that much. So in that sense, the equity, I think, has more power to basically benefit from that inflation. But clearly, we need to be a little bit you know, careful about the valuations on the risk side. The midfielders, I continue to favor real assets to cash, clearly. And I think very importantly, when we look at the defenders and goalkeepers, we already talked about, you know, fixed income and how the bond, amongst others, has lost. Not only is not paying anything, you're taking you know, this transformation of risk-free interest into interest-free risk. You're not paying for this. You're taking a lot of risk, and there's very limited defending. So I think the anti-bubbles, things like insurance, volatility, or gold, or others are potentially better suited. So with that, I conclude a little bit the overview on the macro side. I leave a bit of time if there's some questions. If you'd like to perhaps place them through the chat. If there's any questions on the macro, please place them there in writing. I'll give just a few minutes if there's any there. Otherwise, we can continue and look into the strategy. Any questions from anybody? No questions in the chat. Okay, so if you have any further questions, just feel free to put them in the chat later. So, having reviewed the macro outlook, let's move on to the implementation. Quick update. As you know, the strategy is available in the UCITS format. The strategy is also available through managed accounts, which includes DB Select, which is now live, managing a sister strategy called Smart Gold. And we are in very advanced stages to launch a US onshore fund eligible for US onshore clients. We're doing this with top partners, including Pershing or Allfunds or others. So in terms of the ability for you to access the strategy, you know, hopefully we'll find a way that suits you in terms of regulation and tax and others. We've also been recently onboarded into interactive brokers. So some of you have already purchased through them, even if it's not that easy or some are facing some problems, it is there and will continue to expand. In terms of the share classes, as you know, we have, following the milestones of 2 years and 500 million in Igneo, we are introducing some new share classes. The old share classes continue to exist, but we have increased the minimums, and we've introduced two new share classes which have just been approved by the regulator. We're hoping they will allow us to reduce the minimum investment size for the more mainstream class, and these are available in dollar, euro, and sterling. They are settled, currency settled, they're not hedged. Any further questions on the shares, please let me know. We've also revamped the newsletter. So if the fact sheet, I think you're receiving our email, that's why you're on the call today. But if you look at the bottom, there's a link to the fact sheet. If you click on that, you should be able to download effectively something that looks like this, where you have a lot of details in terms of the positioning and some of the views and what's changed and performance attribution and stuff. Any feedback on that would be welcome. Thank you all. We are about 575 million in terms of assets under management. The bulk of that is in the UCITS, but we're also, as I said, we have the SMAs. We have a pretty solid pipeline, and so thank you all for your ongoing support. And as you know, we've as part of that, we have big and leaders in the consulting space that have already blessed the strategy with their on-site due diligence. Let's look into the strategy, and I'm gonna, again, this is a review of the numbers for this month, the positioning, but also for the benefit of some who might be listening to me or this type of call for the first time. I'm going to touch on some of the basics as well. And you're familiar with this. I insist over and over that when you think about your portfolio, you need to think about it as a team. It's not just the individual pieces, it's how they play together, and how in this game you are the coach effectively. Many of you are not only the coach, you're also striker, but it is a game where us, the external managers or strategies, are there to play a function within your team, and hopefully something that we can complement your own strengths. And I think it's critical that we play the role that we've been assigned. I think in that sense, if every piece is trying to do everything, it's a bit like the schoolyard where everybody's after the ball. In this particular case, as you know, we are positioned as the goalkeeper of the team. And this is critically important because at the end of the game, this is, in order to win, you must first not lose. And for us, it's all about capital preservation, both at the individual strategy as well as the portfolio, and then compounding on this capital preservation. So with that, you see the performance of Igneo. I just highlighted here versus the S&P, which has had a major round trip. Interestingly enough, if we plotted the NASDAQ, we are significantly ahead of the NASDAQ since launch. You wouldn't think so, but there we go. That's the power of capital preservation. And how do we did this, and how is it looking? Well, we have effectively a strategy that has performed quite strongly in terms of absolute returns. These are the monthly charts. You see that it's averaged roughly about 25% per annum since launch. And when you think about the volatility and the return per volatility, most people think about average volatility, which is fine. It's important. That gives us important sharp ratios and information ratios. But as I always say, average volatility may not be the best indicator of risk. First of all, because many distributions are not symmetrical. And so we've seen how in March, for example, lots of people blew up. They had arguably high sharps, but turns out that they were hiding some risk. So we are very much skewed and looking for this asymmetric payout. And so when you think about volatility, we prefer to differentiate between good volatility and bad volatility. This month has been actually the worst month since we launched. It's been a difficult month for a number of reasons. We had obviously on the one hand gold. It's been volatile but pretty uneventful. Throughout the month, we reached as high as 2,080. Crashing the previous historical highs, only to see it collapsing by over 10% in a matter of 2 days, and then recover and then back down. As we discussed before, we expect gold to have a big fight around these historical levels before it clears. But I discussed earlier the dollar, which for us is a key defender as well. That view is challenged as we speak for the reasons I discussed, but we continue to believe that the dollar has a good defending role to play, and some of the options that we have, which bet on gold higher and dollar higher, as the gold leg is performing, are becoming more dollar calls, which give us a big position on volatility and the dollar, which effectively is something we like, will smooth out the strategy, and were particularly effective also during March. We obviously saw equities flying, which means many of our equity puts have been suffering mark-to-market losses, volatility lower, or the things like the Chinese yuan, which is a core view, also much stronger. So not an easy month for us, but we are, I think, well positioned to look ahead. And despite the hostility, we continue to show a very asymmetric profile with a Sortino that is about 3.2, showing this very strong return per unit of negative volatility. But perhaps even more importantly than vol is the correlation, and how this point that I make over and over, which is the risk of false diversification. And this became very obvious in March, but it had already been very obvious in Q4 2018 or other instances. So what you see, and what I mean by this risk of false diversification, is how you think you're diversified because you have some equities, some credits, some emerging markets, some high yields, some commodities, and turns out that when trouble comes, they will behave just like one asset. So in that sense, our goalkeeper role is allowed us to make these very significant gains when the team needed it most. This becomes even more clear in this chart, which shows the performance of the S&P ranked from worst to best. And you see very clearly how three things. First is during adverse and hostile markets, we have a correlation of -1. So every single time that the S&P or other markets have been under pressure, we've performed strongly. The second thing is not only we made some money, we actually made a lot of money, which helped in some cases make even more money than the losses incurred on the other side. And then thirdly, to the best of our efforts, when the markets are more benign or bullish, we try to preserve the capital and make money. As you can see, those correlations are much lower. So this is something that we achieve by construction, by mandate. It's not something you achieve by luck or just because you wake up in the morning and see a light or have a crystal ball. This is effectively our mandate and what we're set up to do. So when you think about the team, and this is critical for us, is obvious that the simplest combination you could have as a team is to create a 50-50 basket between strikers and goalkeepers. That 50-50 basket effectively would give you, as expected, the return would be the average of the returns. But what we can see is that the risk is a fraction of the risk that you would incur with either just strikers or just goalkeepers. You see the drawdown the volatility and the returns being effectively much higher per unit of risk. In fact, this is so strong that we could do what we call smart leverage, which is the opposite of dump or risk increasing leverage, which effectively means, I give the example of my mom always, when she goes to the bank and they say Nieves minus 0.5, and she says, no, I want my 5%. And to achieve the 5%, the banker would say, well, why don't you buy high yield at 1% and lever it 5 times? Obviously, when you do that, if the market goes down 20%, you will lose 100% of your money. So that's risk increasing. Here we're talking about something that whilst your $100 might be invested in, instead of 100 in equity, 80 in equity and 80 in defenders, you are levered because you're investing 1.6 times, but you do it in a risk reducing manner. And this becomes quite clear because when you look at this, we're able to increase the returns by 1.6 times without meaningfully increasing the risk. And even better, and this is to me a critical part of the strategy and the reason why we value a lot the daily liquidity, is instead of fighting the volatility of the market, instead of fighting the rationality of the market, when you're sitting on both strikers and goalkeepers, it means that as the S&P goes to 3550, you're benefiting from that, but also you're doing it in a way that you instead of fighting this volatility, you embrace it. So what it means is that once you have a neutral position, call it 50-50 or 80-80, what you do is you go back to neutral, you rebalance back, you sell expensive, buy cheap, or buy cheap, sell expensive. And as you can see, the incremental, the impact that this would have had, it's very significant. We would have had, in this case, almost 16 points, well, relative to the passive basket is a phenomenal increase, which is money you make while you sleep. So instead of trying to pretend to be, to have a crystal ball, it's in my view much better to find that neutral position and then embrace this volatility. This becomes really obvious once you see back to the original pieces, and you see that this basket is significantly more effective than either of the pieces. Okay, I don't believe in teams with 11 strikers. Just I don't believe in teams with 11 goalkeepers. I think the idea and the balance here is very important. So in that sense, when you compare it back to the original equity position, then it's pretty obvious, the increase or the benefits both in terms of return and risk. And as you know, we are, and it might take a little while still, but we are in discussions with the regulator to launch this 80-80 solution, which we hope will be called Aqua and will complement Igneo and Smart Gold. So with that, I'm going to elaborate a little bit more in on the strategy. I'm going to do it quickly for the benefit of those who, a refresher, but for the benefit of those who haven't seen it before. And then I can see that there's a number of questions now, so we'll go to that after. So in that sense, what we're trying to do in this strategy, and you see, is this is a strategy that is designed to create, first and foremost, we're trying to preserve the capital. We try to generate these large absolute returns during hostile markets, and we try to achieve that with as more of a low, neutral, or even positive expectancy and carry during the more benign markets and bullish markets. So what you see is something that looks like a synthetic put profile, but hopefully in a superior way, both bigger returns and lower drawdown. And this is something, as I mentioned, that is different to a number of competitors or other funds. Like there's some volatility funds that look to make money. If the market's down 20%, I make you money. If the market's up 20%, I make you money. The problem with that is, in my view, our job as goalkeepers is to make the money when things go really bad and try to preserve the capital. We want to be those puts. If you try to catch both sides, at the end of the day, the right-hand side is already caught by the strikers. You want your strikers to be call options to make you money when the opportunity comes. Hopefully you're loaded on all the right things. and hopefully you're rebalancing those into goalkeepers, because I think this will be a prudent thing to do. But how do we achieve this? As you know, the strategy invests in 3 key building blocks: gold, treasuries, and options. We have no leverage, we have no shorts, and we only buy options. Within the options component, which is the most explosive, we only buy options, and we have 2 choices. We can buy puts on risk assets like equity, credit, high yield EM. We can buy call options on anti-crisis and anti-bubbles like gold, treasuries, the dollar, or the VIX. And we do it in a way that is very conservative. I insist, no leverage, no shorts, and long only options. And basically, when you do this, we're looking to, I use the analogy of climbing a mountain. It's not a race to the top. It's not even about getting to the top. It's really about making it back to the bottom. And so when you're buying, if you're up 5, 15, 10, 15, 20 meters and you're pinning yourself to the wall, you can continue to climb. But if something happened, Trump is throwing you rocks or a CTA is collapsing, you're able to survive and protect yourself. So this combination of capital preservation, compounding on capital preservation, responsible for higher absolute long-term returns. And this option profile, we look for 3 things that are pretty ambitious. We look for very cheap options that are very explosive, 5 to 1, 10 to 1, 20 to 1, and that do it with a neutral, or ideally neutral or even positive carry. It's not always possible. Of course, many of our options will suffer from negative carry, but overall is a big consideration in the portfolio construction. So this is a snapshot of what the portfolio looked like at the end of February. You've seen this before, some of you, and you see that at that point we were the best hedge fund in the world in February, with up 10%. And we were going into March with that portfolio, which had basically 23.8% in premium at risk. So if you had 100 million invested, 23.8 were invested in options. These options is a very diversified program, not only in terms of puts and calls, but also through time. So you see the kind of options we have expired in 2020. And there's roughly about 5 to 7% that we tend to spend or seek to spend per year. And then you see what happened, what we have for farther out, 2021, 22, and even all the way up 30 years. These options allowed us to perform very strongly during March, and even when gold and treasuries were collapsing, these options effectively did their job as providing these meaningful returns when we needed them most. And as you see, lots of things happened during that month. We had a situation where, some parts make money, some parts lose money. Some of the options that were according to the mathematical models, with the complacency of the market and the S&P at 3,400, it was very difficult, if not impossible, to think that the S&P might trade below 3,000, let alone 2,600, right? So some of these very cheap options effectively exploded. They became very valuable. Calls on the VIX, puts on the dollar, puts on the VIX and the S&P, calls on the dollar, contingencies, gold, etc. And this portfolio, as we take profits on these pieces, for us, capital or profits become capital. So this capital gets reinvested back to gold, treasuries, and options, and these options are invested on a forward-looking basis. So which we use and actively restructure. So once the dust settles and we're at the end of March, what you see is that the strategy actually is back to some sort of more neutral position, which is roughly back to the 50% in precious, 25% in treasuries, 25% in options. So investors maybe started the year with $100, today may have 145, 150, but the actual composition of that is very stable. And this is very important because it creates a very predictable behavior. The best feedback I got from investors, or at least the best for me, is that we're doing what it says in the tin. Okay, we said we would behave in a given way, we would make money, potentially a lot of money during crisis, we will hold the value, and this is what we've done, and I insist we do it by mandate and construction. It's quite predictable. It's like a goalkeeper that has done its saves and stands up and is ready for the next one. provides a very smooth profile. So relative to whether you invested 2 years ago or 2 months ago or two days ago, you have a very similar smooth profile. It's very much forward-looking, very contrarian in nature. So we are accumulating insurance, I think, against things like China blowing up, or gold higher, or equities lower, some of which might be very contrarian, but this is the time you want to accumulate this insurance. It's a repeatable process with daily liquidity with large capacity. So if you think about how this options portfolio has changed and how some of the opportunities, this is what the portfolio looked like at the end of May. This is what it looked like at the end of June. This is what it looked like at the end of July. And this is what it looks like at the end of August. So you see that there's been a number of positions that have expired, that we've restructured, that we've added. And you know, what we have right now, it's as a snapshot, is you know, roughly about just a little bit over 3% at risk for the balance of 2020 in terms of premium. And then the risk, which adds to about 19.3 in options, is spread out, but a lot of medium long-term plays. Inside of 2020, you see a lot of blue there on the left. You see a lot of S&P versus gold. This is positions we continue to add. They're things like the following. We're betting on or buying insurance, rather, where or betting on against the odds, where the market it's currently effectively pricing a positive correlation between equities and gold. There's been a lot of demand from people who rightly said, we believe that with inflation we'll see higher gold and higher equities. But as gold keepers, we're more interested in things that will pay during the crisis, such as potentially gold up and equities lower. And so we can take advantage of this in multiple ways, but to give you a sense of one of those blue boxes, one of the recent trades, we had the opportunity to buy some put options on the S&P close to current levels, 34.40 or something strike. And that would have cost us for the end of the year in the region of 4.5%, maybe a bit more. We also had the opportunity at that point with gold at 1920 to buy some call options for around the same price. So call it 4.5%. So faced with the choice of should I buy calls on gold or puts on the S&P, we could also do something where we do both, with the caveat that we will only get the worst performer of the two. So if gold flies, but the S&P put doesn't pay out, I'm sorry, or vice versa. If S&P collapses but gold collapses, it doesn't pay either. Now, this comes at a very, very steep discount. So we bought a significant amount of full NAV, about $500 million worth of this for just about 1.2%. So instead of paying 4.5% for either of the two, you get about 75% discount for this correlation benefit. So the market doesn't see a scenario where gold could be much higher and S&P lower. This is not just about how things price and play out. It's also about how they mark to market through time. Because if you see that gold flies, then the worst of insurance that we bought effectively starts to behave more and more like an S&P put. And here we are, loaded on S&P puts all the way from 3,400, and higher to 2,900 over the next few months, in something that obviously, if the complacency continues, if hopefully everything goes really well, then we have some premium at risk. But if you have the unexpected happen or some events, this could lead to very significant gains in the portfolio. So with that, we continue to do our job as a goalkeeper. We thank you for supporting us and delegating that very, very important function. And as you can see, the portfolio continues to grow alongside with the AUM and the capacity. So with that, I'm going to just, as you see, we are, the components of the strategy, the the usual suspects as goalkeepers and defenders are there. They are you know, pieces that will perform in one way or another. In some cases, by construction, you should expect volatility to spike during a crisis. Others, like gold, who knows? Perhaps the first leg is lower if the market's positioned for that, but eventually we think that gold is a big beneficiary of many of the things that are happening and will continue to be the case. So with that, I'm going to open it up for the questions. I can see that there's some now in the chat. If you have more, please put them there. And I'll start with the first one, which is basically asking about what's my view on commodities. Very good question. Very good question. And I would say that I'd like to differentiate between gold and precious metals and other commodities. Because I think at the end of the day, commodities have two forces at play, right? From an inflationary perspective, if you think about the loss of purchase power of the dollar, you will have a common tide where everything will go up, pretty much everything. It'll be real assets, it'll be real estate, it'll be commodities, it'll be anything that you cannot print should go up. At the same time, if my big macro view from an inflation perspective is supportive of any real assets, but I also see a stagflation scenario, which is where some of these artificial valuations and some of these dynamics lead to potentially a very negative scenario, which could result in, who knows, demand collapsing. Having said that, you could also see major infrastructure spend where governments just step back in and say, whatever, let's just print more money, take more debt, build way more infrastructure, and obviously that might be beneficial to some of this. So I think commodities should remain volatile. The trend and perhaps the inertia is higher, but the tail risk is lower, and some of them will suffer more than others. The consideration of emerging market currencies is relevant because a much weaker EM can create significant impact in terms of, margin cost of production. So, and as well as demand. So it destroys a lot of demand if you are a buyer in Indian rupee, and the Indian rupee goes down, then commodities are more expensive. Yet if the South African rand goes down, then the producers enjoy a higher cost of production. So it's not a non-negligible second order effect that could impact commodities. And we saw how that impacted oil, for example, in the collapse when the Russian ruble was left to float, and that contributed further to the collapse. So I think it would be a very interesting area to watch. Within the commodity spectrum, I favor clearly gold and precious metals. I think the more industrial ones will be more volatile. There's a question also regarding an August performance. I discussed that slightly earlier. Let me elaborate further. August was the worst month for us so far, minus 7.2. Lots of things happened. The gold and treasuries pieces, which were more flat, slightly net down. We had other parts of the portfolio, such as I mentioned the dollar components in the options, or the equity, or the volatility itself, or the yuan. And some of these positions are medium longer term. So our options against the yuan might be 18 months or 3 years, but obviously just call it 3 years to go. But in the meantime, those options have become a little bit more further and further away. So they are very much alive. This mark to market is reflected in the premium that you saw earlier. So if I go back to the screen I was sharing, you see that the options themselves. If I go back here, 1 second. I look at the option premium. What you see is that we've seen this bucket going down in value So back in a few months ago, we're sitting closer to 25% in premium, and that's now. Just one second. So here we see the premium of for different months, and you see this is at the end of June, where we're sitting on 25.2% in option premium, and now at the end of August, if I fast forward, you see that that's come down to just about 19.3, and this is despite having added some options and things. So yeah, think about the mark to market of these or these losses. In some cases, it's just mark to market, and we've seen from experience in months before how this can come back and bite with vengeance. So in the meantime, we've been taking opportunity and adding where we felt there was the opportunity, adding some more. So we are just focused on the job, and again, trying to protect that capital the best we can, but at the same time, adding insurance and finding the opportunities that we feel will come and protect us when we need it the most. So next question is, yeah, is there in terms of capacity, look, we have you're as liquid and have as much capacity as your least liquid and the part with least capacity. Here, the precious metals, the treasuries are 100 billion plus. The options bucket is also, there's huge capacity. We're doing each one of these little buckets that you see could be a 250 million ticket with one bank or one counterparty, one maturity, one strike, one underline. So changing these things gives us significant capacity. We don't, when we upsize or downsize, if we're managing 500 million and we have, for the sake of argument, 50 options, if we have an inflow of whatever, 30 million, and we're managing 530 in this strategy, we wouldn't do like 50 mini top-ups of the options. We would basically buy 3 new options, okay? So we would have 530 million and 53 options. And that's roughly how we operate. So you should expect this number of options to increase significantly. We have a target, we're very comfortable up to 2 billion. We'll revisit then, but you would see that this option bucket will become, there'll be a lot of granularity, lots and lots of many trades and options, where each one will be spending very little, 0.1, 0.2, 0.3% of the portfolio, but that cumulatively will give us this large capacity. And so this is something that works very well. And also concentration-wise, mixed blessing on the way up when we were managing less money. Many of you were telling us, Diego, my ticket size is X, but I'm doing less because I can only be 20% of the fund or whatever. So some of these things have been resolved, and now you've been able to increase. But at the same time, it means that our client base is extraordinarily diverse. So we have over 500 clients, and that means also that the ability and the risk of one big liquidation is limited. But even if it happened, the strategy can support full liquidation just within the day. So we think that's a big strength, and in fact, we actively recommend that people take profits and add to the position as part of the overall portfolio. Okay, how are we positioned right now in gold and VIX? We are, gold is a pretty structural position. You can see here on the summary table at the top on this slide that I'm sharing, how out of the 19.3%, about 12.2% of the options is attributed to more like gold upside. That amount of premium is meaningful. On a relative basis, it's one of the strongest views that we have. You can also see that this is not a 2020 bet, it's much more medium longer term. So a lot of the exposure we have is 2022. So we think that the gold move is something that will be a while, and we've been accumulating. VIX per se, we don't have, but we have a very meaningful amount of S&P downside throughout all these blue boxes that you see, and that whilst we're not risking that much, because you can see some of them are worth 0 or 0.1 of the portfolio. I can guarantee that many of these could be potentially very explosive if we had certain events. So we are very much positioned to benefit from a move up in gold as well as the VIX. But yeah, we can do VIX options on a standalone basis, and we continue to monitor that. We just don't have them right now. It's better to do through S&P downsides. Next question is on the inclusion of treasuries as a defender, and the question on inflation versus deflation. Good question. I think, look, I've discussed this before. It's a non-consensus view. If you think about, some people think that there's an inconsistency between my view that inflation is a key risk and key thing in the next 10 years and being long treasuries. Why? Because we've been trained and hardwired to believe that if inflation goes up, interest rates will go up and fixed income will collapse. Well, what I tried to explain at length during the outlook is that the rules of the game have changed. We live in a world where we cannot hike interest rates. We cannot hike interest rates because if you hike interest rates, the whole system implodes. Okay, think about the bubbles in obviously duration with trillions and trillions of bonds at low or even negative yields. Think about what happens to credit. Think about what happens to the zombies. Think about what happens to governments. Think about what happens to your mortgage. Think about the whole thing if rates were to go up. So they can't go up. It's all artificially held with low rates that they can't go up. So what it's changing, and we already see the Fed openly talking about it, is we're going to let inflation run. And we're no longer going to be, our hands are not going to be tied because our measures start to show inflation pressure. We're going to tell you that it was part of the plan and that we want to see the average inflation. And look, we've had low inflation for so long that we want to have that high inflation. So this is just part of the, it fits completely with our view and with this desperate exit. But what it means is that, in fact, the portfolio is currently positioned in 30-year tips. So we have not only the duration, at 1.4%, if the US was to follow the European path and go to 0, you could make 1.4 times 30, which is about 42%, roughly. Plus, on top of that, we have inflation through the tip. So effectively, the 30-year tips still offers very significant upside. Yes, there is potentially risk, and I think it will be volatile. People don't quite understand yet that this is the plan, and you will see that very clearly once the market is under pressure and equities are tested, which eventually they will, even if they look like it's just a straight line from now to eternity. But effectively, once that happens and the market starts to panic and VIX flies, you will see what happens to long-dated rates, and they're going down big way. So, and I think inflation, again, eventually will do that as well. So in that sense, we have that contrarian view, and be careful with the widowmaker of being correct in your view on inflation and basically losing on the implementation, because I think it's a clear risk. On top of that linear position, we also have some very long dated options. I talked about that in previous calls, and how the view of those calls, long dated calls, is effectively a rates view as well as volatility. Next question is very important. It's on the dollar. How do you see the dollar short and long term? This is, I think, one of the most difficult and important questions we can ask. And the fact is the Federal Reserve has made their plan clear. we're going to do whatever it takes to prevent the collapse. We're going to bail everybody out. We'll do whatever it takes. Market is taken on that and become very complacent and bought everything because, some things because they're worth, some things because they're not going down. And the adjustment comes obviously through inflation and the dollar. So in that sense, the pressure is on. But having said that, you have a situation where, like yesterday, it hasn't taken that long for the ECB to come up and say, look, 120 is not cool, and it does matter. So they're obviously watching. Everybody knows that the FX channel is tricky. So this is not something that happens in isolation. In fact, it's very central to our view of what happens, because monetary policy is both a relative game and a contagious game. And as I always say, the only reason we have negative interest rates in Europe is because the Federal Reserve was at 0. Had the Federal Reserve been at 2%, we would have never, ever, ever seen negative rates in Europe. End of story. So with that, I think the euro, the dollar is under pressure. My biggest concern and question is, what else can you do in Europe and other parts other than just blowing up because the euro went too strong, and then of course the euro goes down. So it's a very tricky situation where the Fed is openly going for it, and the pressure is on, but the speculative position is now very extreme, and I think you will see increased volatility in this space. There's another question on if 75% of the portfolio is long gold and duration, and 25% long vol. If gold falls by 30 or 50% and treasury by 3, how much is the drawdown of the fund? I'm trying to figure out my downside. Yeah, look, the question is really trying to assess what's the downside. And I think the important thing, or one of the important things to consider, is that the strategy is not a black box. You guys know the building blocks we have. You can stress a little bit and think about what could happen to the different building blocks and the pieces. And basically, yes, you could run this type of scenario where I'm long 50% gold, gold's down 20%. That's 10% loss. What happens to treasuries? What happens to the options? But very importantly, the strategy is designed to survive and thrive crisis, and we can't blow up. Okay, we could lose money, but we can't blow up. You're not going to have a situation like in March where risk parity was basically forced to cut their position because they had hidden leverage. They had their equity versus fixed income, and they thought they were hedged, and turns out that they weren't. And so as the model showed, they have much more risk than they wanted or they were allowed to do. They were forced to cut. That's not going to happen in our case because we can't blow up. We have no leverage, no shorts, and only long options, which is different from long vol. Okay, I've made this point before. We're long options, long insurance. It doesn't necessarily mean you're always long vol. If you have a big vol bias, but they're two different things. This is the discussion on Black-Scholes versus Monte Carlo that I've had in numerous calls, and some of you have seen also the interviews that I've done recently. So I'm happy to discuss that offline if needed. But yeah, I think that's the downside, and some of you are trying to assess this idea of worst case scenario. Well, worst case scenario, if you're long Apple or Tesla or whatever, is 100%. So no, that can happen. Yes, it can happen. So worst case scenario is worst case scenario. Obviously, is what it is. But I think if we were looking to give some guidance, this strategy, you can come up with those numbers in a conservative manner. And this has been quite a difficult month for us for the reasons I discussed, and hopefully, the stuff that we've been accumulating will pay multiples. Are there still new? Are the new UCITS instruments now in play, or can you? Okay, I think what the question comes with respect to the share classes, I guess, with the share classes. Or the instruments. Well, the strategies will continue to exist. So Igneo exists as it is. The new share classes will continue to exist. It's just that we've increased the minimums. So here the decision is relatively simple. And what currency do you prefer, and what sort of size are you thinking? And that places you in the right share class. Right now we're in a phase where whilst the prospectus is now approved, the new classes haven't been formalized in terms of ISINs and set up. So new orders would probably need some waiver until the others come in. But the idea is to effectively implement the new limits as soon as the other the new share classes are eligible. There's another question on in which I'm just mindful of the time. I can see some people have been coming in, recognize some names, so perhaps they're in for the next call, the Spanish one, which you are most welcome to join. The next question is your interest rate risk debasement inflation scenario where government bonds are perceived to be toxic may force blue chip equities to double as capital free flows bonds or parks into blue chip equities. Yeah, it's look, the framework here of equities just become a number, right? I mean, think about a world where you have negative interest rates all over the place. The cash flow that a company, be Apple or whoever, will earn in 2050, it's more valuable than the cash flow they will receive tomorrow. How crazy is this? And what does it mean to PE multipliers or equity duration, right? We are effectively seeing the impact of the PV of artificially low interest rates resulting in higher equity valuations contributing to the bubble. Just to give you some numerical examples, at 5% interest rates, $100 in 10 years time, if you PV that, they'll be worth 60. Okay, today with interest rates close to zero, $100 are worth 100. And obviously with negative rates is more. So a lot of what we're seeing in equity is, Apple is a good example. We haven't really seen necessarily, and I'm not an expert in this, you are probably way more than I am. But when you look at some of these names, you haven't seen necessarily that big of an increase in absolute levels of profitability. You have seen obviously buybacks, which reduce the number of shares. And then you see the PE going up because of the impact of lower rates, amongst other things. But effectively, this is something that is very populistic, and that goes to my point on the distortion of valuations. And to your point, it's just a number. I mean, who knows? I mean, Tesla has a PE of 1,000, so based on that, anything's possible, right? So that's why I don't believe in just shorting stuff outright, no matter how crazy you think it is. Better to buy puts and to create this team where you need your strikers and you need your effectively not only the strikers, the goalkeepers. So yeah, I think that's a consideration. And obviously the point I was talking about is not necessarily fixed income blowing up. I'm talking about a scenario where the debt monetization is this debt is forgiven and it's never paid back, and it flows back into inflation in the system. But it doesn't mean by any stretch of the imagination that the governments will default on their fixed income. They will default on the currency. They will default on the fact that they will give you back your €100 or $100, but those $100 will not buy you much. So that's the kind of default that you will see on the government side. Is not the default of a Greece or other that can't pay back. I think we're looking at a different scenario. I can see a few more questions still, and I'm mindful that again the other call will start in a few minutes. What do I think on the U.S. elections? And does it matter? Of course, it matters. It's pretty huge. I think the market is now virtually pricing 50-50, and lots of people calling for Trump coming back. I think the potential risk on taxation based on the current valuations and other pieces is very meaningful. So to the extent that becomes not the base case, I think there's significant room for downside just purely on that. But yeah, it's been remarkable. I think how arguably the market is just taking on all the positives of the vaccines and Trump and everything else, and many things have disappeared, and we'll see how it plays out. But yeah, the elections I think are critical, and we'll see. It'll be very, very volatile around the date, and I think there's many things that to watch for. So I'm going to take the last call, because I can see lots of people coming for the next call, and we'll probably hang up. And then if you are either joining for the call in Spanish or want to repeat this wonderful experience in Spanish, then stay with us. But I'll just take another one. Let's look at the last question. Talking about correlation between bonds and gold and equities. I guess this is the question, and that's a fair point. I think when you look at the impact of correlation and how recently correlations have notably increased, this is pretty much a reflection of two of the points we'll be discussing over and over during today's call, which is the weakness of the dollar and the inflation expectations. So I think in that sense, we remain constructive on volatility. We think that there's many factors we discussed, obviously elections, COVID, geopolitics, valuations, bubbles, many others that could potentially test some of the current complacency. And yeah, it's going to be quite an interesting next few weeks and months. So with that, I wish we could continue, but I'm going to take a short break. I want to thank you, everybody. Thank you all for joining this call in English. There'll be a replay available. And if anybody wants to drop me some further questions, just drop me a line. And again, for those of you who joined for the call in Spanish, we will be reconnecting shortly. So thank you, everybody. Hope you found it helpful, and lots of health. Speak soon. Take care, guys.